Coronavirus nightmare. What are the economic impacts and how will this affect the price of gold? If you're interested in gold whatsoever, make sure you stay tuned to the end of this video because I'm going to share some secrets with you that are going to blow your mind. Trust me. I'm going to explain all this to you in 3 simple, fast steps. Step number 1, the supply shock. What is a supply shock exactly? It's very easy. You go down to Walmart, nothing is in the shelves. And you may say, well, George, I think you might be exaggerating a little bit. Really, 94% of the Fortune 1000 companies have part of their supply chain in Wuhan. Not just China, specifically in Wuhan. 5 million companies globally have part of their supply chain in Wuhan, China. What type of companies are these? Editor, throw up the pictograph. To grasp the magnitude of this problem, let's look at the top 10 companies that import the majority of their goods from China. I think you're going to recognize some of these. Walmart, Target, Home Depot, Lowe's, Dole Foods, Samsung, LG, Philips, and IKEA. And it's not just staple goods that you buy on a daily basis. Also, the majority of pharmaceutical ingredients are sourced in China. And car parts, as an example, Hyundai, one of the largest manufacturers of automobiles worldwide, has had to shut down many of their factories because they can't get those parts. They're not being made anymore in China. This takes us to the Chinese PMI. What is the PMI, you may ask? Editor, let's go straight to Investopedia. The PMI, or Purchasing Managers Index, is a measure of the prevailing direction of economic trends in manufacturing. The PMI is based on a monthly survey of supply chain managers across 19 industries, covering both upstream and downstream activity. So basically, the PMI is how well the manufacturing sector is doing in a particular country. Going back to the chart of China's PMI, starts 2012, goes to 2020. It's a measurement from 40 up to 54 in this particular chart. Starting in 2012, it does go up and down a little bit, pretty darn smooth. We get to a peak right here in 2020, New Year's Eve. It gets up to 53. Everyone is celebrating that times are good. The manufacturing in China is doing fantastic. And then whoopsie daisy, what happens here? It drops off a cliff. It literally goes vertical all the way down to 40 on the PMI. Keep in mind, that's a 12-point drop. That is huge. It goes all the way down to a specific point that I am now calling SDT. Can any of you guess what that stands for? I think you can. Stiff drink time. And you may be saying to yourself, yeah, George, I see this chart, but something's got to be wrong. There's no way that it can drop that much, even because of the coronavirus. But what we can do is we can cross-reference that with satellite images of pollution for Wuhan specifically. This will tell us how much economic activity is actually going on. We can start by looking at 2019, the images from January 1st to the 20th, 28th to February 9th, and then February 10th to the 25th. And we've got to look at all those dates because of the Chinese New Year. Then when you compare that to 2020, there's absolutely no pollution whatsoever. And this tells us that economic activity backs up our PMI chart that drops off a cliff. I want to point out one more thing that's extremely important and unique about a supply shock, because I'm sure right about now your friend and family member Fred, who's holding a sign that says I heart the Fed, is coming in and saying, yeah, don't worry about this. The Fed can drop interest rates. They can do quantitative easing. No problem. But what your friend and family member Fred doesn't realize is that the only tools at the Fed's disposal are meant to combat a demand shock, not a supply shock. You think about it. If we have a situation like Hurricane Katrina, where there's just no goods stocked on the shelves, or a supply shock like the oil embargo we had in the early 1970s, money printing or dropping interest rates will do nothing to help that. In fact, it might exacerbate the problem through potentially higher inflation if they can get those extra currency units into the real economy. And oh, by the way, I accidentally watched CNBC for about 30 seconds the other day. And before I could run over and grab the remote to turn it off as fast as I can, I actually came up with a great idea for a question of the day. Who has a bigger man crush on the Fed? Your friend and family member Fred or Steve Leisman? Let me know what you think in the comments below. Step number 2, demand shock. And that is when consumers are not spending money. And in the United States, when consumer spending is 70% of GDP, if consumer spending goes down, that is a big problem. Consumer spending is directly tied to consumer confidence. So I've got a chart of consumer confidence right here, starting at 1977, going to 2017, but I do have data that is current. It's on a scale of 0 to 140. 77, it's decent, but then it comes crashing down because of the recession in 81, comes back up in the 80s, comes back down because of the war and the recession in 90 to 92, then goes all the way back up. We had the internet boom and the dot-com bubble. Stocks at all-time high, consumer confidence at all-time high. My guess, unemployment very low, comes crashing down because of the dot-com, and we have a recession. Goes back up because of housing, and they offload that bust from the dot-com bubble to the housing bubble, but that eventually pops, goes crashing down again. We have the GFC market collapse and a big recession. We're all the way back up to 130 was the data I saw. Of course, that is a direct result of all the funny money the Fed has been printing. Stocks at an all-time high, unemployment at an all-time low. Insert the coronavirus. Stocks were around 30,000 on the Dow, but as we know, they have absolutely crashed. Last time I checked, just a little over 25,000. That is a really big loss, but it doesn't necessarily mean that we're in a recession right now. The key linchpin to that is the unemployment rate. And yesterday we got a very good jobs number. But remember, those jobs numbers are a lagging indicator. That tells us what happened a month ago or 2 months ago. It doesn't tell us what's happening right now. And if we look at the news, companies are sending their employees home. Big companies like Wells Fargo and your favorite HSBC. This is really what we've got to focus on. If the unemployment rate turns in the other direction and jobless claims increase, that could put us into this demand shock that we really need to be worried about. But I'm not the only one saying this. To hear more, let's go straight to Jeff Gunlock.
If this situation with travel and leisure and non-social activity continues, you just wonder if you can keep initial claims down near 200,000 per week. The 5-year moving average of initial claims is around 243,000. And one of the most predictive aspects, economic statistics for recession is when you get unemployment claims on the weekly basis. I use the 4-week moving average because they're so volatile. But if they go above their 5-year moving average, you're done. You can just put a fork in the economy.
Put a fork in the economy. That pretty much sums it up right there. But what is this end game? If we have a supply shock and a demand shock, that's something we have almost never seen in history, especially not in the United States. So I think the net result of that would be consumer prices taking Buzz Lightyear to infinity and beyond, and high-ticket items, including asset prices, completely collapsing. Step number 3, What will the coronavirus nightmare do to the price of gold? I know a lot of you lately may have been scratching your head because gold fell off a cliff. It's back up now, but why on earth did we see that huge price drop at a time with monumental fear in the market? It just doesn't make sense. But wait one moment. Let me put the pieces of the puzzle together for you. I have a chart of the repo fails and the price of gold. It starts in July of 2007 and goes to February of 2009. These blue bars indicate the amount of repos in dollars that actually failed. That means that there's an agreement to do, let's say, a $50 billion repo. And before they get to the specific time where the transaction needs to take place, one of the parties backs out. I'll bet you didn't even know they could do that, did you? But this is the entire repo market. It goes from 1 trillion to 6 trillion. So remember, what we see on the New York Fed's website is only a small fraction of the entire market. It's going right along business as usual until we get to Bear Stearns blow up. All of a sudden, the repo market starts to realize that those mortgage-backed securities might not be so safe. That creates a collateral panic in the repo market. That's why the fails start to spike. But notice what the price of gold is doing. In 2007, fear is gaining more and more momentum. The price of gold goes up, 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 up until Bear Stearns. Then it comes crashing down. But why is it crashing down? Maybe it's because there's a lack of collateral in the system. There's a panic, and all those entities going into the repo market have to sell their gold because they need that liquidity, and they don't have any collateral to get that cash like they normally would have. Then the federal government comes in, changes the rules, and expands the amount of asset-backed securities that the entities can use in the repo transactions. That solves the collateral problem. Fear kicks back in. The price of gold goes up until the government comes back into play and bans short selling on the GSEs. Then fear completely disappears because the market thinks the problem has been solved. Gold sells off until we get to Lehman Brothers. Then fear kicks right back in a big, big way. Gold goes up to $1,000 a share, goes through the roof, then comes crashing down because of Lehman. We had massive collateral issues. Look at what happened to the repo fails. They went up over $5 and $6 trillion per night. Those were just the fails. So we have this huge collateral panic. Everyone sells every ounce of gold they have. Gold comes all the way down to near 600 until the Fed steps in with quantitative easing 1, starts printing money. This puts a Band-Aid on the collateral issue, but fear sets right back into the gold market, especially because they see the expansion of the Fed's balance sheet. This takes the price of gold around 700 up almost 50% to 1,000. Now, I know this may be shocking to a lot of you, and you may be asking yourself, George, what are you talking about? You mean to tell me that the repo market actually has something to do with the price of gold, and that's a cross current? And if there are all these repo fails, that has the tendency to push down the price of gold in a crisis. That is just crazy talk. Where are you getting this chart? I got this chart from a good friend of the channel and repo expert. You might know him. His name is Jeff Snyder. So I'm guessing the question on everyone's mind right now is, George, what are these repo fails and what are they doing right now when we're in the middle of the coronavirus nightmare? Editor, help me out with that. They're directly correlated to the oversubscribed repos that we're seeing on the New York Fed's website. If you've been following this channel at all, you know as of the last few days, the oversubscribed on the term repos have gone through the roof. This gives us a specific answer as to why there could be a lot of downward pressure on not only gold, but silver, the miners, and Bitcoin. But this is great news for all of us who are bullish on those asset classes. Why? Because the Fed is going to solve this problem, or solve this problem, like they try to solve every problem. And that's with more and more money printing. So if they do achieve their objective as to getting these fails and the oversubscribed repos down to a manageable level, that means that the collateral issue goes away and we get right back to where we were in September of 2008, where now all that's left is fear and money printing, sending the price of those assets to infinity and beyond. The main takeaway is the solution the Fed has, the only solution, is the exact thing that will make all these asset classes go parabolic. But let's take it right back to gold. If we assume that gold is going up, if we are bullish in the future, what's the best way to play it? What is the best strategy that allows us to maximize on our returns? To dive into that a little deeper, let's go to a clip of my full-length interview with Marin Katusa. Correct me if I'm wrong, but the price of gold itself and the price of the GDX, and if I'm not mistaken, Rick with Sprott, went up about 40%, but some way you invested in gold, it went up by like 90%. So first and foremost, am I saying that correctly? And if I am, can you kind of maybe walk us through the structure of how you created a return that was so much more substantial than gold itself or guys like Rick?
There's a few reasons why. Not because I'm smarter, that's a debate for another day, but it comes down to this. I'm the largest investor in my fund. And rather than owning 40 stocks, I really honed in and focused. And since Macro Voices, we're up another 50% since then. So it's like well north of 140%.
Wow.
My whole focus is being first to the story, structuring these products where you also get a warrant kicker. Okay, so when you do a financing, you almost get, if it works out, you get paid twice. One thing I want to share is when I wrote up, I was the first guy to write up the potential in Newmarket because they were buying Fosterville. That became Kirkland Lake. I did that at $1 and change. That ran to $60. My mistake there was I sold too early. And I did a whole analysis about how to sell and my mistakes. And now what I've actually told people is, look, you're sitting at like a 400% gain on this stock. You should probably reduce, and it's called the Katusa free ride. But I'm holding on because I believe there's nothing better than this deposit in the US. And until I'm proven wrong or it gets taken out, I'm going to run with this. So there's the aspect of knowing what to buy, but then I get in and explain to people my psychology about, holy crap, we're sitting at 480% gain on this. Should I sell some? And it's a struggle with an emotional going, maybe I should reduce my risk. And there's other times that, the stocks don't work out that have had big runs. So it's a process. Just because I've done very well over the last 8 years doesn't mean the next 8 will be great. But every day is a battle. It's a tough market. And for me, it's an honor to be compared to guys like Rick.
For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, make sure you check out my full-length interview with Marin Katusa tomorrow, and check out this playlist right here, and I will see you on the next video.